Hey everybody, welcome back for another dividend investing video. And Happy New Year! 2022 is behind us and the S&P 500 dropped nearly 20%. If you've been investing in 2022, you were loading up during the worst stock market year since 2008. Historically, this has paid off for investors, so well done. The sector I'm going to highlight today is the consumer staples or the defensive sector, given how the market has been behaving over the last couple years. Staples have long been ideal stocks for dividend investors with their predictable revenue and cash flow. And these are companies that I want to own in a recession. Today, I'm going to highlight 3 dividend growth stocks of great companies in that sector that are looking like quite a bargain in the current market beginning 2023. I am Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I am not a financial advisor, just a guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor and smash that like button and subscribe to keep up with future videos. This helps us out more than you could imagine in bringing you quality dividend investing content. And I want to say a quick thanks. We are now at over 7,500 subs on the channel, and I'm blown away. We are just getting started, my friends. Help me get to that 10K mark and hit subscribe. You have my sincere thanks. So while the markets were down over 20%, the consumer staples sector did much better. It's down only 2% over the last year. This is a look at the Consumer Staples Select Sector ETF, which trades under the ticker XLP, and it contains the 34 largest consumer staples companies on the U.S. market, weighted by market cap. Here are a look at the top 10 holdings. The largest company in the sector is Procter & Gamble, ticker PG, at 15%, followed by both Pepsi and Coke, both around that 10% mark. And these top 10 stocks here make up 70% of this ETF. And the companies I'm featuring today are not in the top 10 at this time. And for a reasonable 0.1% expense ratio, you could invest in the sector this way. But personally, I prefer to put most of my money into high quality companies that have history of paying and growing a dividend and building my passive income. So let's go over what I think are the best deals in the sector right now. And I know your time is valuable, and I appreciate you spending part of your day here with me. Real quick, let's go over the criteria I use to select these companies. I want a PE to be lower than its 5-year average, and for staples, I'm okay with a PE being in line with its average because these are defensive stocks and they usually have a very low beta. I want a dividend yield that is greater than its 5-year average. I don't really care what the yield is so much, only relative to itself. And my third criteria is a well-covered dividend. Every business is unique and can tolerate different payout ratios. So I go with a Simply Safe dividend safety score of 60 or better. And I also want to see a dividend growth track record of 7+ years. It's pretty straightforward. More subjective, I don't invest in businesses that I don't understand. If I can't explain to a middle schooler how the business makes money, I'm not going to invest in it. And if I wouldn't invest in it, I'm not going to feature it here on my channel as an intriguing opportunity. I also prefer to see things like growing revenues and a positive outlook on the future of the business. So let's get into it. My 3 dividend growth stocks in the consumer staples sector that look appealing right now. And stick around, I'll give one more bonus company I think is worth a look that might be a little more risk. Company number 1 is Kroger, ticker KR. Kroger is an American grocery retailer with stores in 35 U.S. states. These are stores that customers have to visit regardless of the state of the economy. Now in these stores, Kroger features their own private label brands, typically at a discount to their brand name competitors. They're attempting to become even larger and merge with competitor Albertsons, a deal that still needs to be approved by federal U.S. regulators. With Kroger, investors have exposure to what I see as an ideal business in a recession that has generated market-beating returns and double-digit dividend growth. Kroger's stock performance over the last year is close to flat. It's down about 3.5% compared to the S&P 500 being down about 20%. Let's see if Kroger fits all 4 of our criteria. Kroger trading at a 10.9 PE, which is 13% below its 5-year average PE of 12.6. So criteria 1 is check. Kroger is trading about as cheap as it has in the last 5 years. Kroger pays a market-beating yield of 2.3%, which is 11% above its 5-year average of 2.07%, so that checks off criteria number 2. Now, how safe is this dividend? Kroger's dividend takes up 25% of its earnings and 36% of its free cash flow. The Simply Safe dividend safety score is at 71, so this looks pretty solid. Criteria 3, check. Kroger is quietly developing one of the best dividend growth track records in the consumer staples sector. Its last dividend raise was at 24%. And with 15 years of dividend growth, that meets our final criteria. Kroger pays the quarterly dividend in the months of March, June, September, and December in the amount of 26 cents per share for a total annual payout of $1.04. I like to see growing revenue in companies I invest in, and with Kroger, we have nice, steady revenue growth. In 2013, they brought in $96.6 billion in revenue, and in 2022, they brought in $146 billion in revenue. Kroger also regularly buys back their shares at a fairly aggressive amount. Another thing I really like about them as an investor, they had over 1 billion shares outstanding in 2013, and today there are less than 750 million shares outstanding. The average analyst price target for Kroger is at $53.19, representing almost 18% upside from current levels. We did a valuation video on Kroger that I put out last week where I attempted to estimate a proper value and a buy price, and I came to a similar conclusion as the average analyst price target there. Check it out there in the description of the video. I highly recommend it if you're considering opening a position in this grocery retailer. This is one that I've been buying up in our dividend growth income portfolio. We're building up a nice position in Kroger for the long term. I'm really happy to be doing that. Company number 2 is Tyson Foods. Tyson Foods is an Arkansas-based food processing company and the world's largest processor of chicken, beef, and pork. With its subsidiaries, it operates major food brands like Jimmy Dean, Hillshire Farm, and Ballpark. Ooh, that makes me want some sausage. Lots of solid brands and household names, and I myself have long been a customer of Tyson Chicken for as long as I could remember. It seems like that's usually the brand I pick up at the grocery store. Now, 2022 is not kind to Tyson Foods. They've been hit as hard as any business by the rising costs, and I see this as the value play out of the 3 I'm presenting today. The stock is down over 27% over the last year, most of it during the last 6 months. In fact, the stock price is lower today than it was 5 years ago. At the time of publishing, we're only a few dollars higher than the 52-week low. So Tyson's forward PE of 10 is at a discount to its average PE of 11.6, the 5-year average, and it's not traded at this low of valuation since 2020, making this an intriguing opportunity and fits our first criteria. Awesome. The PE of 10 is far below the sector average of 22.1. The dividend yield is at 2.9%, and this is 31% above its 5-year average yield of 2.21%. Criteria 2, check. Now, if you can get this at $64 or cheaper, you will have it at a 3% plus yield, and I think that is an excellent yield for Tyson Foods. The dividend makes up a mere 29% of forward earnings, and while it usually does not make up a large amount of its free cash flow, for 2022 it made up 83%. But this is an outlier when put up with the rest of their historical data due to the short-term headwinds we've been facing in the economy. Now, free cash flow was down massively in 2022, as it has been for many companies. But still, the Simply Safe Dividend Safety Score is 99, seen as among the safest dividends in the sector by Simply Safe Dividends. So, criteria 3, check. And Tyson Foods has 10 years of dividend growth, growing its dividend at a rate of 15% annually on average over the last 5 years. So criteria 4, check. Note, the latest dividend raise was a bit more underwhelming at 4.3% compared to their more recent history, but this is likely due to the drop in free cash flow. Another positive note that's 31 years of uninterrupted dividends and no cuts. Looks like it was simply maintained for a long time and even through the last recession, which I consider to be a plus. While we want to see dividend growth, during a recession I will take a dividend that is maintained over a dividend that is cut. In Tyson Foods, they take a quarterly dividend payment in the months of March, June, September, and December in the amounts of 48 cents for a total annual payout of $1.92. Tyson has healthy looking revenue growth over the last decade from $34 billion in 2013 to $53 billion in 2022. Shares outstanding have declined after a jump in 2015. It would be nice to see the share count decline some more. This seems like an ideal time for the company to buy back some more of their own stock if they have the funds to do so, at least. The average analyst price target is just under $78. This represents 18% upside from current levels. So Tyson is a company that looks like a value play right now. I think it's begun to attract value investors in addition to long-term dividend growth investors like myself. Short-term, it is facing a lot of pressure on its margins as price of materials continue to increase. And I don't own shares of this one myself. I did consider adding to my dividend growth income portfolio when I started it up back in September. I ultimately went with some other choices, but it's remained on my watch list and it's going to continue to do so in 2023. I do think there could be a few more rough quarters for this one. But look, in truth, nobody knows what's going to happen. If you think a rebound is likely, then getting Tyson at a 3%, close to a 3% yield while you wait could be the way to go. Company number 3, Hormel Foods, ticker HRL. Hormel Foods is an American food processing company founded in 1891 in Austin, Minnesota by George A. Hormel. Initially, the company was focused on the packaging and selling of ham, sausage, chicken, beef, and lamb products, and in 1937 added this canned meat stuff called Spam. Their other brands include Skippy Peanut Butter, Jennie-O Turkey Products, and Planters Nuts, among others. It's quite possible, even likely, you have Hormel products somewhere in your own kitchen. These are great brands from a high-quality packaged food company. Hormel Foods is down just 5% over the last year, but right now it is trading just a couple bucks above its 52-week low. Looks pretty interesting to me. PE is 24.9. This is about in line with its 5-year average, and for a company like this, that's perfectly fine and passes the first criteria. Packaged food companies like this usually trade more expensive than the average company. That's not too much higher than the sector average of 22.1. Hormel's dividend is trading at a 2.34% yield, which is 14% higher than its 5-year average of 2.05%. So criteria 2, check. The dividend makes up 58% of forward earnings and 66% of free cash flow. Both of these metrics fall below 70%, which is our preference for a consumer staple packaged food company. Simply Safe Dividends gives us a safety score of 99, making this dividend look rock solid and easily checks off criteria number 3. Did I mention that Hormel is a dividend king? 57 years of dividend growth easily passes our 4th criteria, and that 5-year average annual dividend growth rate is 9% in the high single digits. Here is the dividend payment schedule. We have a quarterly dividend paid out in the months of February, May, August, and November. People often ask me for good companies that pay in those months, and Hormel definitely fits that bill. The dividend payment of 27.5 cents gives us a total annual payout of $1.10. Revenue has grown over the last 10 years. You see a long period of consistent revenue, which is pretty common for a packaged food company like this. But with this, you have extremely reliable cash flow. They're not buying back shares, but they aren't issuing a whole bunch either. These slight increases are likely due to something like executive or employee compensation. The average analyst price target is about $45, right around the current prices. But this isn't the kind of company I would buy and hold for capital appreciation. This is for consistent dividend income and safety in a recession. And I think companies like this, with that very low beta of 0.22, consumer packaged goods, they have a place in a dividend investor's well-diversified portfolio. And I think shares of Hormel are at a place that look attractive for long-term buy and hold dividend growth investors. You hold these more for defensive purposes. Notice that in the last recession of 2007 through 2009, performance of the stock was down 15%, while the S&P over that period dropped 50%. So this is a boring, reliable stock, and I like that. The dividend increases continued through that last recession, and I'd say there's a solid chance that Hormel would weather the next recession by continuing to grow its dividend. Those are my consumer staples picks, what I think are looking solid for dividend investors right now in the beginning of 2023. Remember, these are not buy recommendations. I'm just sharing some of my own due diligence, hoping it will help you with your own. And as promised, let's quickly talk about one more of the consumer staples sector I think as a potential buy for dividend investors right now in 2023, although I will say this one has more risk than the other 3. I am talking about Walgreens Boots Alliance, ticker WBA. I've been buying this one in our public account. It's been yielding right now at 5.46%, and this is one I consider buying for higher income. This is a drugstore retailer with a huge store footprint. I think most of us in the States live within a few miles of a Walgreens. Right now, shares are available at a PE of only 8.2, and dividend growth has been slow, but they've been growing the dividend for 47 years and have been paying uninterrupted for 91 years, and that is one heck of a track record. Simply Safe Dividends gives us a safety score of 79. Now, Walgreens is going to have to step up and make some changes to compete with Amazon and the like, but this is price attractive in my humble opinion, and they may be due for a turnaround. But like I said, this one does carry some additional risk in my opinion. Thanks for sticking around, folks. If you are still here, you can certainly smash that like button for me and subscribe because you dig this stuff, you know it. Also, if you aren't following me on Twitter, you can do so at Div Growth Income. I love connecting with you folks and talking all things investing. For full disclosure, I am long Kroger and Walgreens. I'm also considering opening positions in Hormel or Tyson Foods sometime in the next couple months. Until next time, folks, keep investing.